Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. As always, I'm excited to be here with all of you. This is actually episode number 81. Yes, we've done 81 episodes, and I'm very proud of the fact that, most of you have been listening to our podcast since the very, very beginning. We have continued to be getting a tremendous amount of downloads on a weekly basis, so that's helping our podcast along those lines as well. And today I'm going to be doing part 4 of a part 7 series on understanding your financial paradigms in retirement. Actually, we're going to be paying a lot of attention today to Social Security issues and concerns during your retirement years. So we're going to be discussing the causes of Social Security taxation, what are the Social Security thresholds, what is the real cost of Social Security taxation, what is the long-term care cost of Social Security taxation as well, and then last but not least is, how can we avoid the taxation of all your Social Security benefits in retirement. So again, I'm excited to be here. Please make sure that you download our episode so that way if you subscribe to our episode and to our channel, then you will be automatically notified when a new episode comes out every single week. So without any further ado, let's get into Social Security, because this is one of the major questions that I get asked most often by many of my clients and many of the new clients that come into our offices on a weekly basis or that we happen to engage online. And their biggest issue and concern is, why do I have to pay taxes on my Social Security benefits? Didn't I pay taxes on those benefits when I contributed to them to begin with? And the answer is absolutely. You paid 7.65 while you were employed. Of the 7.65, 6.20 went to cover Social Security, and then 1.45% went to cover Medicare. And then if you work for an employer, your employer also made a similar contribution on your behalf toward those benefits. So I think the one major question is Social Security taxation will be taxed if you happen to have way too much money in certain buckets that we're going to be discussing, or tax buckets that we're going to be discussing in the first few minutes. But the big question also that I get asked, or the second big question is, what is provisional income? Because, Bert, you keep talking about provisional income calculations and their impact on Social Security benefits, but what is provisional income? And the definition of provisional income is the income the IRS tracks in order to determine your Social Security taxation. Now, what counts as provisional income? Well, a lot of stuff counts as provisional income, but let me give you a list of the things that you need to pay attention to in order to minimize those tax liabilities. They count as provisional income all earned income. Whether you retire, you start collecting Social Security benefits, and you continue to work full-time, or you work on a part-time basis, all earned income is going to be included in the provisional income calculation. Also, distributions from your qualified plans, your 401ks, your IRAs, your SEPs, your 403bs, all those distributions are going to be added to the formula as well. Your required minimum distributions, or RMDs, if you happen to reach the age of 70 and a half, and now you have to start taking distributions out of your 401ks and IRAs, whether you want or not, those distributions will get added onto the formula in order to determine the taxation of your Social Security benefits. 1099 income from your taxable bucket. So if you have monies in traditional mutual funds or savings accounts or CDs or money market accounts, and those accounts earn an interest during the year, well, you're going to be receiving a 1099 from the financial institution where you had those funds deposited, and then you're going to have to report those, and they're going to be part of your provisional income calculation. Pension income. For those of you that are lucky enough to have a pension, whether it happens to be a public pension or a private pension, those pension benefits will also be included onto the calculation. Rental income. What if you own a piece of property, or you own a small apartment building, or you own a home and you have it rented out? Well, that income will also be included in your provisional income calculation. Interest from municipal bond funds. Now, this is an interesting one because, most clients and most people that own municipal bond funds think that municipal bond funds are federal income tax-free and totally tax-free. Well, they're partially correct. Municipal bond funds are federal income tax-free. Now, they may or may not be state income tax-free, depending on the state that you purchased that municipal bond from and what state you live in. So that's obviously remains to be seen. But if you live in Florida, or let's say you lived in California, which has state income tax, and you purchase a California municipal bond fund, then obviously it will be federal income tax-free and also state income tax-free, because you would be helping the state in which you purchased the bond from. But although that's the case, the income that you receive from those municipal bond funds will get added on to the provisional income calculation. So they're not totally tax exempt, as most people think. And then on top of that, you have to add half of your Social Security benefits. And then obviously, once the calculations are done on all the income that is reportable for taxation on a given year, and that will form part of your provisional income calculation, then the next thing that needs to be looked at, and this is something that each and every one of you needs to pay attention to, would be, well, if I have all of this income, then what are the Social Security thresholds? And the Social Security thresholds to determine whether you're going to have to pay taxes on your Social Security benefits or not are divided whether you happen to be married or you happen to be single. So if you're married and you're filing jointly, if all of these income sources that I just gave you a couple of minutes ago, if all the amounts of those income sources are less than $32,000 in a given year, then you will pay no taxes on your Social Security benefits. Now, if the income is between $32,000 and $44,000, if you're married filing jointly, then up to 50% of your Social Security benefits will be dragged in to the tax calculation to determine, how much of that you'll have to pay in taxes. And if that income under the provisional income calculations exceeds $44,000, then up to 85% of your Social Security benefits will be taxed in retirement. I'll give you an example of that in the next few minutes as well. Now, if you happen to be single, and your provisional income numbers are less than $25,000, then you pay no federal income taxes on your Social Security benefits. But if your income is between $25,000 and $34,000, then up to 50% of your Social Security benefits will be taxed in retirement. And if that income exceeds $34,000 as a single filer, then up to 85% of your Social Security benefits will come into play for taxation. And it is very, very important that you start doing those calculations as you start getting closer and closer to retirement, because then if you see that your provisional calculations may actually exceed the thresholds, then at least you have a few years available in which to start shifting more and more of that income, from the taxable bucket and the tax-deferred bucket to the tax-free bucket in order to avoid the taxation of your Social Security benefits in retirement. So another question that I get asked is, well, this makes all the sense in the world. And Bert, I was not aware that I was going to have to pay taxes on my Social Security benefits as well in retirement. The next question is, well, what is the real cost of Social Security taxation? And I am going to give you an example because this is one that we deal with on a regular basis here in our firm when we start doing provisional income calculations and tax planning for our clients, not only here in Florida, but the many clients that we have throughout the United States. So let's say that in this example, the provisional income calculation is $115,000. Obviously, the marginal rate for these clients, which are married filing jointly, will be in the 22% range. And let's say that their total Social Security benefit is $30,000 a year. 85%, because they do exceed the $44,000 threshold as married filing jointly, now up to 85% of their Social Security benefit will come into the tax table to determine how much of it the clients are going to have to pay in taxes. So in this case, 85% of $30,000 equals $25,500. So that $25,500 will be added on to the tax table. And then $25,500 times the 22% marginal tax rate equals $5,610. So out of the $30,000 of Social Security benefit for this year, for the year, this family had to report $25,500 of it for tax purposes, and then the tax liability on those $25,500 was $5,610. So the other issue is that, well, all of a sudden you didn't think that you were going to have to pay taxes on Social Security benefits, but now you find yourself, with a deficit of $5,610. So what do most Americans do? Well, in order for these clients to offset this tax liability hole, they need to take an additional $7,192 out of their retirement accounts in order to net $5,610. So because of the fact that the taxation of their Social Security benefit created a deficit of $5,610 in their personal economy for the year, they need to dip into their IRAs and 401ks to take an amount equal to $7,192 so that when they pay taxes on that additional $7,192 coming out of those accounts, they can net out $5,610. So one of the major challenges and one of the major discussions that I have with a lot of the clients that we do tax planning and tax audits for is that the taxation of your Social Security benefits may very well accelerate the depletion of your retirement assets, because as you continue to pay more and more in taxes on these benefits, then you need to dip into your retirement accounts in order to offset not only that tax liability, but also you want to net out the same amount that you had to pay in taxes in order to maintain your standard of living. So the faster, the more taxes you pay in retirement on your Social Security benefits, the faster the depletion of your IRA accounts will be. Many a times, by paying taxes on your Social Security benefits, you will find yourself that you may very well be depleting your retirement assets anywhere between 5 and 8 years sooner than expected, as opposed to not having to pay taxes on those benefits while you're collecting your Social Security along those lines. So it's important to have a clear understanding, especially before you get to retirement, how the distribution of Social Security benefits and how the provisional income calculations will factor into your depletion of retirement assets in order to hopefully avoid not having to run out of money before you run out of life. Now, I think the other issue that is important to discuss along these lines and the real cost of Social Security taxation is, well, then what is the real long-term cost of Social Security taxation upon benefit distributions? So let me give you an example. Along the same scenarios, remember, we need to take $7,192, pay taxes on that money in order to net the $5,610 that we had to pay in taxes on a given year because of the fact that the total income under the provisional income calculations exceeded the $44,000 for this married couple filing jointly. So now 85% of those benefits are taxable for that given year. So if you take the $7,192, and let's say that you would have been able to grow those assets at an 8% rate of return. And I'm being, a little aggressive here, but, pick your poison. Could be 5%, could be 6%, could be 7%, could be 8%, could be 10%, depending on how aggressively you're investing your assets in those retirement accounts. But if you take the $7,192 at 8% over a 20-year period, then that equals $362,642 of retirement income that you actually had to give up because of the fact that you had to plug in that hole, that retirement hole, due to the provisional income calculation and the taxation of your Social Security benefits. But it actually gets worse. Is not the impact of those $7,192 that you didn't allow to continue to grow because of the fact that you needed to dip in order to offset that hole over a 20-year period at 8%, but also is the fact that Social Security benefits have a tendency to adjust for inflation every year. So the higher your Social Security benefits go, as long as you're above the threshold, the higher the tax liability. Because remember, the tax liability also compounds from one year to the next. So if those benefits continue to rise, then that means that your tax liability for every year and every year thereafter will continue to go up as well. And that will create some major problems for you and your family during retirement. So how do we avoid Social Security taxation? Well, if you're closer to Social Security or if you're closer to retirement, then there are a number of things that you could do. If you happen to be in retirement, then you need to do some tax planning. Perhaps it makes sense, if you're already collecting Social Security benefits and you're in retirement, to do a lump sum conversion from an IRA to a Roth or from a 401k to a Roth, and pay the higher tax in the 1 year, but then avoid that taxation every single year moving forward. But if you still have anywhere between 5 and 10 years away from retirement, what are some of the things that you can do? Number one, Roth IRAs. You may want to start shifting your contributions from your traditional 401k to a traditional Roth. And the reason for that is the fact that the single greatest contributor to Social Security taxation is having too much money in the tax-deferred bucket. And the tax-deferred bucket is that bucket that contains all of your IRAs and your 401ks and your pensions and your 403bs and so forth. So again, what are some of the things that you can do? Well, start making more contributions to your Roth IRAs or your Roth 401ks. Start shifting away from making contributions to your traditional 401ks and traditional IRAs and start shifting that to the Roth portion of the equation. You may also consider, if you happen to be at least 59 and a half, you may consider doing some Roth conversions, so at least you can pay the tax today, because we're living in the third lowest taxable bracket in the history of our country. Pay the tax today, but now you're making certain that even if taxes were to double in the future, which, my feeling is that they're going to have to, based on all the issues and concerns and the tax liabilities and the debt and the national debt and the unfunded liabilities that we have in this country, there's a very high probability that taxes are going to be a lot higher in the next several years than they are today. Then at least you're paying the taxes at today's rate and not have to worry about much about the tax liability in the future, because then all of your assets would be hopefully protected from that future tax liability. So Roth IRA contributions, Roth 401k contributions, Roth conversions, and then last but not least, 7702 plans, or contributions to 7702 plans, which happen to be properly structured cash value life insurance plans that enjoy tremendous benefits under the IRS code. And those are primarily the only vehicles, the only vehicles that will allow you to offset the taxation of your Social Security benefits in retirement. So again, these are things that you need to consider as you work through your retirement distribution planning. Always remember that planning for retirement is a journey. So there are many different issues and concerns that we're going to be covering in this part series, in this part 7 series that we're doing. And again, we have already done part 1, 2, and 3, and today is part 4. So stay tuned until we get to part 7, because it's going to give you a lot of different ways and what are the issues and concerns and what are the things that you need to pay attention to in order to make certain that you and your family can enjoy a successful retirement life, as well as as the minimization of your tax liabilities in retirement. Again, I want to leave you with one final thought, which I leave you every single week, is that my number one goal is to help all of you, not only you, but also your families, kind of change the way that you see things, because when you change the way that you see things, the things that you see change. So again, if you want to have a discussion regarding this issue or something else that bothers you or keeps you awake from a financial standpoint, please feel free to reach out to me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I'll be more than happy to have a discussion with you at no cost or obligation. So again, have a wonderful week. I'll see you again next week, and have a great day. Take care. Bye-bye.